Thanks for watching. Today I'd like to talk about standard versus itemized deductions and the impact on your tax return. When you choose to use the standard deduction on your personal tax return, the 1040, you're going to get a fixed amount that is set by the IRS every year. For instance, in 2019, the single standard deduction was $12,200. The married filing jointly standard deduction and qualifying widower was $24,400, and the head of household was $18,350. There is an additional deduction if you're over 65, blind or disabled. They would give you $1,300 or $1,650 respectively. So you use the standard deduction when you really don't have anything to itemize. Comes right off your taxable income, reduces your AGI by that amount. That's what you're taxed on. The first deduction on the Schedule A is the medical deduction. Now, the medical deduction isn't a dollar for dollar deduction. You have to have more than 7.5% of your adjusted gross income. Then any excess over that is what would get deducted. Now, this deduction can include your health insurance, doctor's co-payments, prescriptions, even mileage to and from the doctor. And we'll get into detail on that in a later video because there's a lot to know about medical deduction. But this could be huge if you fit the criteria. The next deduction that I want to speak about is your taxes. Now, in this part of the Schedule A, this would include state income taxes paid, property taxes paid, and this is the deduction that everyone talked about in 2018. They called it the SALT cap, and this is the state taxes that got capped at $10,000. So for instance, if you had real estate property taxes and they were $20,000, it wouldn't matter because you were only going to be able to deduct up to a total of $10,000, a total of state taxes paid of $10,000. Next item on the Schedule A is for the mortgage interest. You will be receiving a 1098 from your lender, and this is the area of the Schedule A where mortgage interest goes. Next item on the Schedule A deals with charitable donations. Now, this is generally where you're going to put your cash donations as well as any non-cash donations. You may donate a car, boat, RV, even clothing, furniture. This is where this goes. A lot more to know about this. It's not as easy as it sounds, but this is where that goes. Next area deals with casualty, theft, and losses. This is a pretty complex area. This is not something you really want to tackle on your own unless you really have some knowledge about it. And we will get into that on another video as well, but this is where that would go. And then lastly, we are going to talk about your other expenses that you could itemize. In previous years, you were able to put down unreimbursed business expenses, employee business expenses. That's gone in 2018. So now you would put things like your gambling losses, and maybe estate taxes that were paid. So as you can see on a completed Schedule A in the example on the slide, this particular taxpayer would have had over $19,000 of itemized deductions. So if they were a single taxpayer, then they would itemize. Obviously, the $19,000, more than $19,000 is a better deduction. But if they were a married filing jointly return, obviously the standard of $24,400 is better. They would not be itemizing. So that's pretty much how the Schedule A works. Hope this helped. If you have any comments or feedback, please list them in the comment section below. If this video was helpful, helped you understand how standard versus itemized works a little bit better, hit the like button and please subscribe. We plan on having weekly updates for any changes in the tax rules, and certainly if you want to see anything here, let us know in the comment section below.